Just joining me now to talk markets and investing is Altium Wealth Portfolio Manager and Market Strategist Michael Lee. Michael, good to see you this morning. What do you want to focus on here in terms of the China deal, the Fed, ECB meeting coming up? What's most important?
So what I think is the most important is manufacturing in the U.S. The U.S. has added 500,000 new manufacturing jobs in the last 2 years, which is nothing short of remarkable. What I think everyone is missing is a multiplier effect that's going to take effect into the economy. So $1 in manufacturing is $1.89 to the economy. Every new manufacturing job is responsible for 2 to 4 other jobs as you look into it. And what's really crazy and what's happened over the last couple of years is the U.S. resurgence in manufacturing. I think that has put the economy on a much sounder footing. And while we didn't have 4 or 5% GDP growth last year, we had 3. I think the chances of us falling below 2 or slowing into that secular stagnation that many were worried about that we were heading into in, say, 2015, 2016, it's just not a reality. And we're set up for a lot more continued growth.
Well, we got the February jobs report out tomorrow morning, 8:30 a.m. Eastern. The unemployment rate is expected to tick down to 3.9%. We're expecting 180,000 jobs added to the economy. Is this largely priced in? I mean, you talked about manufacturing jobs at the top. What would be a market mover from this report tomorrow?
Well, so what I'm looking for is not only the headline number, but the revisions. So we got, a 300,000 number in December, which is guided down to 225,000. A 300,000 number in January. We'll see what that's revised to. So tomorrow, if we get a big blowout number, we have 2 lower revisions, I would say, that's fine. But if we're somewhere in the neighborhood of 200,000 jobs, this is good. This is steady growth. In terms of a catalyst, if we have another 300,000 number, I think that could push the markets higher.
But look at these markets here. We had a really nice beginning to 2019, but this week is the weakest week, worst week for Dow, S&P, NASDAQ in several weeks.
Yeah, it seems like we ran out a little bit of a gas here, and I would say to most investors that have missed this rally, this is probably the beginnings of what could be a good entry point in that the Fed is on hold. Okay, the Fed has decided they're not moving for the time being, and I think that's more political than it is economic. So if you look at the Taylor rule, and the Taylor rule is the equilibrium between containing inflation and maximizing economic growth, that puts the front end somewhere between 4.25 and 4 3/4. So the fact that the Fed's stopping where it is now in the low to mid 2s means that they want the U.S. to win these trade wars.
Yeah.
They want sustained growth. They want a strong equity market. And so why fight the Fed?
Yeah, one of the top stories in the Journal today about the trade deficit, basically that the U.S. trade deficit expanded 10% last year. We mentioned it early, $891 billion, despite the effort by this administration to narrow the gap.
Yeah, I don't know that narrowing the gap is the best metric. I think you want to look at total trade, and total trade for the U.S. expanded just under $370 billion last year. That's the largest growth since 2011. And also, tariffs in China have come down in 2017, 2018 from just under 10% to 7.5%.
Yeah.
So what we're doing, our economic strength, the tariffs, all of these policies are working in our favor. And if these policies weren't working in our favor, we wouldn't have added these manufacturing jobs, which I think can have many long-term positive economic benefits.
Does it bother you that not just the Dow is having a tough week, but even the Dow transports? You're looking at the worst performance here in 11 weeks or so.
No, I mean, markets can't go straight up forever or straight down forever.
Yeah.
So,
and you are talking about a very good rally year to date, 11% or something.
Yeah, a very strong move in a very short period of time. Eventually, you kind of run out of gas.
So what do you want to do? You want to take to the sidelines now, or should we be looking at this market for entries?
I think, look, this is an extraordinarily difficult market to trade. So if you miss this rally, if, say, you were adding cash in the fall and you did not get invested after Christmas, now's the time to start getting in, because I ultimately think before the year's over, we hit all-time new highs on all 3 major indexes.
Wow, new highs in 19, even though earnings are slowing down this year.
Yeah, but we still have 5% revenue growth, and I'm a big believer that earnings are managed and manipulated to fit corporate strategy, and market sentiment and all sorts of other factors need to be taken into account in addition to earnings. So with 5% revenue growth, not really stretched multiple valuations, and what I think will be much greater economic growth this year, I'd say the GDP comes in the high 2s versus the low 2s, which most people are predicting, meaning 2020 should look a lot better than I think people are looking at right now, and then 2020 earnings will be the story as you move into the back half of 2019.
That's what we're going to be trading on, the 2020 numbers. Yeah, it's a good point. Michael, good to see you.
Thank you so much.
Thank you so much. Michael Lee joining us there.